but there's a lot of efficiency in a master policy as well. So for example, several years ago, we own a lot of Dallas Fort Worth properties. They had the snowmageddon, if you will, it's kind of the layman's term. There's a deep freeze unexpected that rolled through and affected a lot of real estate, including our portfolio. So we had 5 or 6 properties with leaks and busted pipes and different things that this deep freeze caused. We got to pull one claim with our insurance policy. We got to cover all of those properties simultaneously with one deductible, which was very efficient and streamlined instead of having to manage 5 or 6 claims at any given time. The thing about real estate, when you're a big owner of any type, is it can get very logistical, having to manage all this kind of stuff. So a lot of efficiency built into it. Things like, there's always going to be something, right? A kitchen fire, a flood, a tornado, a hurricane. It's just nonstop. It's not a matter of if, it's when and how you're going to handle it.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Travis Watts. Travis is a full-time limited partner investor and the director of investor development at Ashcroft Capital. He dedicates his time to educating investors who are looking to be hands-off when it comes to real estate investing. And in just a minute, we're going to speak with Travis about mitigating risk and maximizing returns with portfolio-wide insurance. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Travis Watts. Welcome back to CREPN Radio.
Hey, Darren, it's great to be with you again. Thanks so much for the invite. I appreciate it.
Well, I'm delighted to have you and looking forward to our conversation. And before we get started, if you could take just a quick second and share with the listeners a little bit about your background.
Sure, yeah. I'm a real estate investor through and through. I got started early on. I was 20 years old, and I got started with single-family homes like many people do. And, first had a roommate helping me pay a mortgage, which kind of, turned the light bulb on for me as to what passive income is all about. That led to some buy and hold rentals. That turned into some fix and flips. That turned into some vacation rentals. And after about 6.5 years of doing that business model actively with individual ownership, I got a little burned out. I was a full-time W-2 employee in the oil and gas industry. So I worked 14-hour days, 100-hour work weeks. Most of that was spent away from home, out of state, out of country. So it just got really tough to manage a portfolio like that. And so in 2015, I discovered real estate syndications and private placements and what it meant to be a limited partner investor. And it was just a much better approach and a path for me to help scale passive income and tax advantages and equity upside and all the things that we all love about real estate. So I've been doing that now for nearly a decade, a full-time LP investor. Joined forces with Joe Fairless and Ashcroft Capital in 2019. Done a handful of director roles over there with the company. And I just help other investors today understand what private placements are and what real estate syndications are. And that's what we're talking about here today. I love your topic of risk and risk mitigation. I think it's more important than ever. We've learned so much over the last few years, and excited to dive into that.
Well, I'm excited to talk with you about it because as an insurance broker, I was talking to you a little before we started recording, is that in the insurance industry, it's notorious for the kind of the shorthand language where people in the industry talk the terms all day, you know, and I don't know that we're fully appreciative or um, understand the buyer side of the equation, and from a standpoint of multifamily syndicator with the portfolio and the insurance challenges, especially in the insurance market we're in, it's I'm looking forward to getting your perspective and kind of your thoughts on this. And
Yeah.
so to start with, I just want to ask you, so the insurance market, and we are recording this in July of 2024.
Yeah.
The state of the insurance market it's the toughest market I've seen in my career. And I got my license in January of 1990. So 34 years of doing insurance. And when I got into insurance, they talked about coming out of the hardest market they'd ever seen. And this one trumps it, by multiples. But I guess my question, from your perspective, what is it that you've seen in the years that you've been in insurance, or not insurance, in real estate,
Mm-hmm.
from a buyer side of dealing with insurance, and what you thought of it when you first got into real estate as opposed to what you're seeing in today's market?
That's a great question. And I'll start just by saying, clearly on this podcast, you're the expert in this realm. I'm going to highlight a few things from my own perspective, but I do not work in insurance, but there's some things I've seen as a limited partner and through these various groups, and obviously the rapid changes that we've all seen in the past 5 years, let's call it, that I'd like to point out for your listeners as to how you might mitigate some of this risk or tackle these hurdles. So first of all, I'm a resident of Florida. We've been here many years. I would say in the last 3 to 4 years in particular, just as an individual homeowner, our policies have more than doubled. And also as an investor with many groups, including Ashcroft, I invest a lot in the Florida market and in Texas as well. And those are the two states, in my opinion, that have seen some of the strongest, price hikes since we've hit, peak inflation of 2022. And what's interesting is that, going back to projections of deals that I was investing in 2018 or 19 or even 2020, I don't think many of us could have predicted or seen this in particular coming, these rapid increases. So, we had to forecast and underwrite for what we would assume insurance costs would be 5 years down the road as we tackle these deals, right? And so I would have thought, a reasonable expectation might be, 30% higher or something like that, not double or triple. So, Ashcroft's a big operator in the space. We've acquired over 21,000 units, and we went through a whole vertical integration process when we were just peaking over $1 billion of assets under management. And one of the things that we did, thankfully, and something to think about whether your listeners are a GP or an LP, is we started to do a portfolio-wide insurance policy, okay, a master policy, if you will. And right now, we're acquiring, just as a practical example, our 6th deal in Orlando. Okay, so we're in Sarasota and Fort Lauderdale and Jacksonville and Clearwater, Tampa, all kinds of markets throughout Florida. But as I mentioned, these price spikes have been very intense over the last several years. Now we have hindsight of 2020, we can predict, conservatively moving forward that maybe we see rapid rises continuing where we didn't have that advantage before. So this is why it's important. We also operate, we're Sunbelt investors, first of all. So, we, Texas, Florida, Georgia, North Carolina, different markets. So having a master policy covers our entire portfolio under one insurance policy. So it reduces, the rates per property, right? Because let's say that North Carolina property that's insured is going to help offset a Florida property that we acquire. So there's just kind of that baseline discounting in a sense, but there's a lot of efficiency in a master policy as well. So for example, several years ago, we own a lot of Dallas Fort Worth properties. They had the snowmageddon, if you will, it's kind of the layman's term. There's a deep freeze unexpected that rolled through and affected a lot of real estate, including our portfolio. So we had 5 or 6 properties with leaks and busted pipes and, different things that this deep freeze caused. We got to pull one claim with our insurance policy. We got to cover all of those properties simultaneously with one deductible, which was very efficient and streamlined instead of having to manage 5 or 6 claims at any given time. And the thing about real estate, when you're a big owner of any type, is, it can get very logistical, having to manage all this kind of stuff. So a lot of efficiency built into it. Things like, there's always going to be something, right? A kitchen fire, a flood, a tornado, a hurricane. It's just nonstop. It's not a matter of if, it's when and how you're going to handle it. So we've got within a master policy, I mentioned kind of the efficiency of it, but also we have full actual replacement costs on our properties. So it's not a baseline or a guesstimate or an average of valuations in the area. It's an actual full replacement cost. If something, does happen to a property, we get reimbursed that full amount. And also, real estate, what's great about real estate, it's an investment type that you can insure, which is a great feature. You got to think about all the alternative things that you could invest in where insurance is not even an option. So at least we have that upper hand advantage. But the last thing I'll say is that in our policy as well, we've put things in there for risk mitigation, such as full reimbursement of what would have been collected in rents. So if we have 10 units go down for any reason, we're able to collect what would have been collected in rents, assuming that we have to displace our residents, move them either offsite or into other units or what have you. So again, from a high level, you being the expert, Darren, that's why we went to a master policy. I've been asked before with smaller operators that only have 3 or 4 deals, they're saying, maybe it's not in the cards for them. I don't know all the ins and outs of it. It's just something to think about if you are reaching scale, especially if you're operating in other states, and more particularly if you're invested in Texas and Florida in the United States too. Just something to consider, and one way we mitigate risk for our investors.
No, I think there's definitely some value in a master policy. And I think one of the key advantages that you have over a smaller investor is the spread of your risk. You're not in one property, you're not in one city. You are getting a blend of a rate, like you mentioned, North Carolina versus Florida. And I'm curious on the number of doors you have and your kind of your target investment. Is there an age? What's the oldest property you guys have? Do you have any idea?
Some of the older properties, so just for added context for your listeners, I'm generalizing, of course.
Mm-hmm.
When you get started as a general partner in the space without having the broker relationships and the track record and the brand recognition, it's common that you're going to start with like a C class or maybe a B minus type property, right? A 70s, 80s, maybe 90s type property. What we've done is we started as Dallas Fort Worth as our hub, buying properties like that, kind of the B minus C plus, and anywhere from 125 units to 250 units. Those were our roots and our beginnings as a company. Today, we're buying a 2021 built Class A property in Orlando, Florida, in one of the top 3 fastest growing submarkets in the US. So a lot's changed. And a big part of what changed is that, we now have track record, momentum, lots of broker relationships, lots of buying and selling relationships. And we started selling our deals as we were purchasing nicer and newer product to institutional buyers. And that was a huge shift, the Goldman Sachs of the world and the Blackstones of the world and stuff like this. And so they're usually looking for more of that core asset, that B plus, A to A minus, or A plus in some cases, but we don't do new development and brand new stuff. Everything we buy is stabilized and occupied. So to answer your question, I'd say our oldest property in the portfolio, and I'm only guessing because I don't have the data in front of me, is probably like a 1975 property, and then the newest being this 2021 built property.
Got it. Well, I know that here's a couple of challenges that smaller investors, and I'm guessing that, and let me back this up just one second. How long ago was it that Ashcroft went to a portfolio policy?
I would say this has been roughly 3 to 4 years ago.
Okay.
Yeah.
And the number of doors that you had 3 to 4 years ago?
Would have been roughly 12 to 13,000, somewhere in that range.
Okay. So clearly the element of size is no longer a question. I mean, because whoever the insurance company is, there's a lot of premium based on the exposure. There's lots of values and lots of premium. The challenge I think that most buyers have is that they have, 1, 2, maybe even 10 or even 20 properties, but they haven't breached the premium threshold to where there's more premium coming in than there would be, any one loss kind of thing. And so you're constantly on that line of, a little kitchen fire is one thing, and hopefully you've got the controls in place with your tenants and your lease and the renter's insurance, and that you can collect from that you're pushing the risk towards the tenants as opposed to absorbing those on your own policy.
Correct.
But clearly the scale, the age of the properties, you're not dealing with any turn of the century type properties. There's enough premium there that you're able to attract options from carriers that go, okay, we can collect enough premium here to pay the claims, also, make a profit and, move on. I'm curious too, do you have any idea what your deductibles are? Because that's typically something I see on the larger portfolio type policies is larger deductibles, but it makes sense because you've got enough, capital to absorb.
Right. Right. Exactly. I don't have the data offhand. I
Okay, no,
apologize.
I didn't mean like
Yeah.
dig into your policy and do a policy review, but I'm just as a
Yeah.
matter of like, so like an individual investor, it used to be like $1,000 deductible was kind of pretty standard thing, but anymore I'm seeing more of my clients are taking on 10,000 as kind of a minimum, just based on just inflation
Yeah.
and the cost of repairs. What once used to be a small repair is now sizable, but in an effort to kind of contain the cost, deductibles one of the ways they're doing it. Um, and the fact that you're vertically integrated, has Ashcroft always been vertically integrated?
That's a good conversation. No is the short answer. We chose to specifically and intentionally not go vertically integrated day one. We wanted to, well, of course, just see where this goes, right? As a company, make sure it's going to work out. And so when we hit $1 billion under management, and today, for reference, we're almost $3 billion under management, we were outpacing and outgrowing the third parties that we were using, both for construction management and property management. We were comprising about 40% of the entire portfolio of our third party property manager. So there were pain points that were unfolding as we were rapidly growing and expanding. We couldn't have a lot of control over the talent that was being hired and who was who was being put on what property, lack of attention to detail. Of course, no one cares more about your property than you do as an owner. And just infrastructure in general was lacking there. So we started Birchstone Residential. That's our own in-house property management company with only one client, and that's Ashcroft Capital. So we're not out there managing other people's deals. And then Birchstone Construction is our construction arm. And when I say construction, we don't do new construction, new build product. We're talking about just turning units and doing countertops, flooring, windows, appliances, paint, crown molding, fixtures, stuff like that. So, it's the biggest thing, Darren, I'll share this too, aside from vertical integration and deciding to do that later, and for the pain points that I pointed out, we also took in-house and trademarked our own procurement process. It's called Sure Home, where we're buying the majority of the materials needed to turn units directly from the manufacturers overseas, custom made and designed for our properties, having those shipped to Texas, trucked up to Dallas where we have warehouses, and then putting them into ready to go individualized kits that get shipped directly to the property once we acquire and close on it. And then we have our own team and staff on site to open up that shipping crate and have all these individual boxes for unit 101 and 102 and 103. And so that's cut our turnaround time down to 14 to 21 days, and in this business, time is money. We started seeing a lot of supply chain disruption is what prompted this to happen throughout the pandemic. So we've got enough inventory to turn about 2,000 units that we haven't even acquired yet. And, we save about 30% on material costs compared to what we were spending previously. And again, this conversation's all about scale. This may not make sense if you own 2 or 3 properties or have 100 units or what have you, but when you have 21,000 units acquired and you're saving 30% on procurement and you're saving on shipping and you're cutting down on environmental impact like styrofoam and plastics and colored cardboard packaging that's just not necessary, it does have a big ROI that flows directly through to the investors. And I'll give you a very practical example of this procurement process aside from the 30% savings. If we take a flush mount light, for example, which nearly all of our units have more than one of those, it's common as you install those to accidentally break them or for a tenant to accidentally break them over time. So what do you do in a normal instance when you break a light fixture? You have to replace the entire light fixture, right? Potentially 2 light bulbs plus, the glass, the framing, the whole thing. So for us, being that they're custom designed, they have 1 light bulb instead of 2. It's an LED bulb that comes pre-installed in the unit. And then if the glass breaks, we have the actual parts and the components on site just to replace the glass because more than likely the frame isn't damaged. And so we don't need to go spend $20, $30, $40 to replace these lights. We could spend $1 and just replace the glass or a small LED bulb. So again, you think about $10, $20, $30 savings over 21,000 units, it's millions and millions of dollars saved that again benefits the investors and of course benefits us as a company and as a GP operator.
Well, yeah, the efficiencies you're able to achieve over any smaller investor are like mind blowing, when you think about just like you're talking about having warehouses full of stuff and the separate business units for the procurement and the construction. I've got a prospect I've worked with that similar in scale where they actually realized how much floor covering they were buying and opened up a floor covering store to a retail one to, you public can go in there and buy it, but that it's where they, it's for them primarily. And it's just, there is a point. I'm kind of curious in your, you said $1 billion in assets before you guys went vertically integrated on the management net, but I'm assuming that the pain points were well ahead of that. Is there what were some of the tells or things that you saw, or were you a part of Ashcroft at the time, or do you know of the kind of some of the pain points, points that were recognized that made it, and I guess you already talked about more of the being
Yeah.
able to control the people, but I'm just kind of curious if there was specific points that you can point to.
Yeah, there were issues. So I came on at a really opportune time in hindsight. I didn't know it in the moment, but Joe Fairless being, kind of the marketing arm and, the podcaster that he is and the author and the conferences and plus being a GP and being investor relations and being all these things, I recognized just as an LP, he was getting overwhelmed. They were growing fast, doing more deals than ever, and they just didn't have the team and staff in place at the time I came on board. And so the first thing I did is help launch an investor relations arm, and we hired several, investor relations members, and then we had separate marketing arms and everything else. So the pain points were starting, yes, well before we went vertically integrated, which was around again 2021, 22, so a few years in. The some subtle things, that even I saw as an LP is again we didn't have a lot of control over who was being put on what properties. There was a lack of transparency because we weren't under one roof in house, right? So we had one representative as a property manager who was manipulating numbers on occupancy and collections to try to get a bonus for themselves, for example. And obviously they got fired and this kind of stuff, but not having the accounting under one roof, right? Not being able to say up front, like, we don't want that person in charge of this property. That wasn't our say so because it wasn't our business and it wasn't our company. And so there were these types of pain points, but we're very management focused at Birchstone Residential and Birchstone Construction. So we started by hiring at the top, managers that have been in this industry, 20, 25, 30 years in some cases, and then leading the teams from there. And it's kind of a trickle down effect. So on the construction side, I'll name one specific pain point. They would have one general contractor overseeing dozens and dozens and dozens of subcontractors. It just wasn't enough oversight. Things were getting missed and overlooked. And so now we've got 40 different levels of managers, both regionally and in Dallas, and then on site on the properties, overseeing just a handful of subcontractors. So a lot more attention to detail, better key performance indicators, less vacancy, higher collections, and none of that oversight that was happening in years prior were some of the outcomes to that.
Um, so getting back to the insurance program you
Sure.
guys have, so a master policy. Do you know if you guys are using a going through is it an actual carrier, or is it a program? I know there's differences, especially with the portfolio that you guys have over multiple states. I
Yeah.
know, a lot of times what we run into is carriers are very specific about the states they want to be in. And
Yeah.
Florida and Texas are not usually those states they want to be in. Um,
Right. Yeah.
for weather related reasons.
Right.
So I'm curious, do you know if it's an actual carrier program or an actual more of a program that's usually what I find is that there's very similar to a syndication.
Hmm.
You have a deal sponsor, you have somebody that has the idea, and then they solicit actual carriers to back it. And a lot of
Right.
times they're Lloyd's based type
Yes.
programs. Does that sound kind of like
That's
what
how
you use?
we've approached it. Yes. Hmm.
Okay. And then in addition to that, with again your portfolio being kind of far and wide in the Sun Belt, a lot of times there's the broker you have. I'm assuming you guys are working with
Yes.
a international broker, not the local Darren in Portland, Oregon kind of thing. Uh, but but just for licensing and the ability to facilitate, um, to handle all that. Is that Am I on the
Yes.
right path? Okay.
Yep. Yep. You
And
got it.
you mentioned replacement costs. I know blanket limits are something that a lot of times with the larger portfolio we try and achieve. The whole point of any kind of limit structure is to eliminate any kind of penalty to the insured, the insurance buyer, in the event of a claim. You want to receive the maximum benefit that you're due without any kind of pushback from the insurance companies or, like, gotcha, kind of
Right.
a thing. Do you have any idea on that, or is that good?
I don't,
Okay.
unfortunately. Yeah.
Okay, well,
Sorry.
not again, not trying to review your insurance policy, but more, I guess, share with the listeners a little bit about some of the aspects of a program, because if you're buying a property, and whether it be Florida or Texas or Oregon or wherever it is, typically a local provider is going to be the solution
Yeah.
for you. But as you get to a point where you've got a spread of risk across multiple states, and you've got, thousands of doors, the premium that's involved attracts the interest of insurance companies because it's a bigger sale. You've got one client more, and again, the spread of the risk is really what they're attracted to.
Yeah.
When we talk about the age of the properties right now is one of the biggest um, issues we run into. It used to be
Yeah.
that we had carriers that would go, oh, we'll write, as long as it's been updated. Given the
Yeah.
marketplace right now, with um, well, basically you have carriers pulling out of states, you
Yes.
know, uh, to where a lack of availability of product, uh, the ones that are still remaining, that are kind of the primary solutions for the smaller investor, uh, those carriers are narrowing the focus of what they're looking for. And it starts with the age. And
Yeah.
if you've got something that's older than 30 years, a lot of times they've got a hard line saying, sorry, we don't want it. And
Yep.
it's in this market where you have so many people being affected by the insurance costs, so many people are shopping for insurance. The insurance companies have an unlimited supply of potential customers
Yeah.
because everybody's shopping. So now they can go, no, we like that one because that one's newer, and we like that. We don't like that one. That's older. And even if you've done all the updates, like, we don't want that. And
Yeah.
so that's that's just kind of a function of the market, supply and demand. And
Yeah.
again, for the listeners, when you get into an Ashcroft kind of a situation where you've got so many doors and you've got the spread of risk, a program is ideal for that type of a risk, and they can kind of provide a lot of custom coverages,
Yeah.
that are broad and rich with coverage, um, because of just the way it's structured, and I mean, they're great. I had one years ago that was basically given away earthquake. I was writing West Coast properties, including full earthquake, for what other companies were willing to write just for the fire insurance,
Yeah.
and made a lot of friends with that until it blew up. And
Right.
then, and,
Right.
and that's one of the challenges with this is the insurance market has been exposed here as of late, in that, as their costs increase, or as their claims increase, they look for other ways to navigate and or minimize the risk that they're taking on.
Yeah.
And as such, either they may pull back from the market, or like a syndication in real estate where you have an exit date,
Yeah.
insurance syndications are put together very similarly, and
Yeah.
that we're in for this many years. If the program sponsor can't find another uh, backer to back the program, at the end of that, whatever that original investment was, 5 to 7 years, then the program may cease. And so it's
Right.
it's a fluid marketplace. And I don't mean to go on and on about insurance stuff, but I wanted to make sure the listeners understood based on kind of what you've been describing as opposed to what they may be facing in their
Yeah.
market. Kind
Well,
of,
let me paint a little color to it. Just as,
yeah,
again, I'm a
yeah,
resident of Florida. We've lived here before all this inflation period and this chaos that we're in in the insurance world. So I've got well, I'll start with the age of construction. So I've got a buddy of mine right now. He's flipping a property in Daytona Beach, okay, South Daytona Beach, 1966 built property, 2,200 square foot home. They just got a quote the other day for $3,500 a year for a basic coverage on that house. Now, for some perspective, we live in a fairly new home in Central Florida, and our policy's like under $2,000 to insure. And there's just these drastic differences on the age. The other thing is, we moved from virtually a brand new home a few years back, and it was block construction. And the last couple of deals we bought here at Ashcroft have been block construction. And here in Florida, I mean, it has a tremendous impact on your premium. That house that we had that was newer and nicer and nearly twice the size of our current home actually had a lower insurance policy than what we pay on our house now. So, I'm giving just practical layman's terms, real examples, just for your audience to think about. If those are the differences that you're seeing between age and construction, think about buying apartment communities that are 400 units a piece, times 17 properties in the state of Florida. It really does make a huge difference. And it's something to consider, especially with the older vintage and especially in markets like out here in Florida and Texas.
yeah. No, and you bring up a good point too, even about the construction and also the proximity to the coast.
Yes.
Orlando is definitely a safer bet for insurance companies than the Atlantic coast or the Gulf Coast
Yep.
kind of thing. So definitely some words of wisdom there. Um, well, I appreciate you kind of sharing and again the more of the size perspective of the opportunities that exist at scale. We've talked about the operations and kind of the growing pains and the opportunities for more of a portfolio policy and the benefits there and it's all true and I think as a goal for anybody that's an investor and if that is your goal is to grow to the size or maybe not as big as Ashcroft but just there are some benefits at size where you can take advantage of some pricing that's not available when you're just starting out. So
Yeah, I
that's
think,
good.
Darren, in a quick recap for your listeners, all the things that we just talked about, I think to me, my perspective is that from when I got started in 2015 with syndications through, let's say, 2020 before the pandemic, it was gaining a lot of popularity, the space in general. The tax code was being pushed that direction with the Tax Cuts and Jobs Act of 2017, 100%, bonus depreciation, stuff like this, crowdfunding platforms left and right, and cheap dollars, right? Cheap debt, relatively 3-4% loans for years and years and years and years. And we're in the midst of a very rapid bull market. So it was easier to make money then. It was easier to find product like a true vintage class B or C property that had 400 units and none of them had been touched for 20 years. And that was a real opportunity to boost rents to 300, over just a few years. And it happened. And, I was fortunate to experience that as an LP, as many of your listeners probably were as well. But we have changed with this recent market cycle shift and with interest rates and with inflation and now with things being proposed of rent caps and all this kind of stuff, it's coming down to a different era, which to me is an era of what are you doing as an operator? And are you a true operator in the space? Are you really long-term in this industry? We've seen a lot of shakeout happen over the last 2.5 years. So the things we're talking about are the things that are aside from just your typical value add. We're going to turn a unit, and bump the rents. These are operational efficiencies, and they matter more than ever in today's environment.
Yeah. No, definitely the operation side is where you can make your value add today. So that's good. Excuse me. Hey, Travis, by day, we've talked, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk, and that's not an option. We look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk, and that's what an insurance policy is. And as such, I like to ask my guests if they can take a look at their own situation. It could be your clients, investors, the insurance market, whatever you identified as to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer.
Okay.
And so if you're willing, I'd like to ask you, Travis Watts, what is the biggest risk?
So I really haven't changed, this opinion since I started investing in syndications years ago. And it's that as a limited partner, if you're going to invest in a real estate syndication, whether it be office or multifamily or car washes, industrial, whatever it may be, you really have three primary risk categories. Again, not just three, but three primary risk categories. That is the operator that you're investing with, that is the market you're investing in, and that is the deal itself. I've always put the most emphasis on the operator, right? So bet on the jockey, not the horse. And I think, again, that's more important than ever as to the shakeup in this market cycle shift that has been unwinding over the last 2.5 years with interest rates and capital markets and cap rates going up and valuations coming down. Who are you working with as an operator? What connections do they have? What's their track record? What's their level of transparency? Are these folks really in it to have your best interest? And what are they doing about the things that have popped up? And what are they changing to mitigate risk moving forward?
No, the jockey is definitely more important today than in recent times. So I appreciate that. Travis, where can listeners go if they'd like to learn more or connect with you?
So I created a simple landing page for your listeners, speakwithtravis.com. I've got my calendar link on there. I've got latest opportunities and offerings with Ashcroft. I've got a quarterly report that I put together. I've done this for the last 2 years where I pulled data across the spectrum from the most reputable sources that exist so that there's an unbiased report as to what's happening economically. Where are we in the cycle? What are the opportunities that potentially lie ahead? So speakwithtravis.com, you can find all those resources there.
Got it. And with is spelled out?
I'm sorry, what's that?
Speak with, W-I-T-H?
Correct.
Travis?
Yeah.
Okay.
Speakwithtravis.com. Yep.
Got it. Well, Travis Watts, I cannot say thanks enough for taking the time to talk again. Always enjoy it. Learned a lot and look forward to doing it the next time.
Thank you, Darren. Thanks, everyone.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this time. Until next time. Thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.